Welcome, everyone. In the world of business, nothing feels better than making a sale. But what happens when that sale goes sour? When the customer simply never pays? This is a fundamental challenge, one that every single business has to grapple with. So today, we're going to dive deep into the accounting mechanics that handle this exact scenario. And here's the surprising part. The moment a company officially gives up on collecting a bill is almost never the moment it actually impacts their profit. Let's explore why. All right, let's put ourselves in the shoes of a company's financial manager. You've got this big number on your balance sheet called accounts receivable. Now remember, this isn't just a number, it's a critical asset. It represents all the money your customers owe you. You're counting on that cash to make payroll, to pay your suppliers, to invest in new projects. But we all know that in the real world, not every single dollar gets collected. So the crucial question for any decision maker is, how do you account for that reality? How do you officially acknowledge a loss without making your company's performance look like a wild roller coaster ride every quarter? Well, this brings us to one of the most important principles in financial accounting. You see, well-managed companies don't wait for disaster to strike. They don't just react, they anticipate. They know, based on years of experience and data, that a certain percentage of their sales on credit just won't be collected. It's a predictable cost of doing business. So rather than waiting for a specific customer to default, they proactively build a financial safety net. They prepare for the inevitable. And that safety net has a very specific name in accounting, the allowance for doubtful accounts. Now, this is a special kind of account we call a contra asset. Contra just means opposite. So its job is to sit right next to accounts receivable on the balance sheet and reduce its value. Think of it like a rainy day fund set aside specifically for bad debts. At the end of a period, say a quarter, the accountants will estimate how much they expect to lose from the sales they just made. This isn't a wild guess. It's based on history, on industry trends, on the current economy. They might say, we expect 1% of our sales this quarter will go bad. They then record that 1% as an expense for the period, called bad debt expense. And at the same time, they put that same amount into this allowance account. This is absolutely critical. They are recognizing the expense in the very same period they made the sales. Okay, so the company has made its estimate. The allowance account is funded, ready, and waiting. Time passes. Then the phone rings. It's the news they expected but hoped wouldn't come. A specific customer, who owes, let's say, $1,000, has declared bankruptcy. There is zero chance of collecting that money. Now it's time to dip into that rainy day fund. It's time to execute the official write-off. Now, this is the part where many students get tripped up, so let's walk through it carefully. The write-off itself is a purely mechanical process that only affects the balance sheet. It's just two simple steps. First, you have to remove that specific $1,000 invoice from your total accounts receivable. Logically, you can't claim someone owes you money anymore if you know you'll never get it. Step two, you reduce your allowance for doubtful accounts by that exact same $1,000. You're essentially saying, okay, we're using a piece of the fund we already set aside to cover this specific loss. The key thing to notice here is what's not happening. There is no expense, no impact on profit, not at this stage. To really make this crystal clear, let's look at the numbers. Here's a snapshot of the balance sheet before we write off that $1,000 invoice. The company has a total of $100,000 in accounts receivable, but being prudent, they've already established an allowance of $5,000 for expected losses. This gives us the most important number on this table, the net realizable value of $95,000. This is the amount of cash the company actually realistically expects to collect. It's the honest number. And here is the aha moment. This is the balance sheet after writing off that specific $1,000 invoice. So what changed? Well, accounts receivable went down by $1,000 to $99,000, and the allowance also went down by $1,000 to $4,000 because we used a piece of it. But now look at that bottom line. The net realizable value is still exactly $95,000. It hasn't changed at all. Why? Because we didn't lose any value. We simply confirmed something we already suspected. We moved $1,000 from the general, we think we'll lose this category, into the specific, we know we lost this category. The total expected value remains the same. All right, so if the net assets of the company didn't change, that brings us to the question that every CEO, every investor, every manager truly cares about. What did this do to our profit? What was the hit to the bottom line? Let's really think this through. The company just officially acknowledged that $1,000 it was counting on is gone forever. Logic would tell you that's a loss, right? An expense. It has to reduce your profit for the period, doesn't it? And the surprising answer is no, it doesn't. The actual write-off has zero, absolutely zero impact on the company's income statement or its bottom line profit for that period. This is a fundamental rule. And here's the reason which I want you all to remember. The company already took the hit to its profit earlier. That bad debt expense we talked about, that was recorded back when the company first made its estimate and funded the allowance account. The write-off itself is just the final chapter of the story. It's the administrative cleanup that confirms that our earlier estimate was, in fact, necessary. Now, you might be thinking this is just some quirky accounting rule, but it's so much more than that. This entire process is designed to create an honest, stable, and reliable financial picture. It's about providing useful information for making smart business decisions. So why is this system so important? Well, first, it presents a far more realistic value on the balance sheet. Investors don't care about what you've built, they care about what you can actually collect. Second, it perfectly follows the matching principle, a cornerstone of accounting. This says you must record expenses in the same period as the revenues that created them. The cost of a bad sale belongs in the period the sale was made, not months or years later. And finally, and maybe most importantly for managers, it prevents wild swings in profits. Without this method, a company could look incredibly profitable one year and then report a massive loss the next year when they finally write off all their old bad debts. That kind of volatility makes it impossible to manage a business effectively. So let's end with this final thought, which really gets to the heart of the matter. If the write-off isn't the moment of the loss, when did it actually happen? In the world of accounting and sound business management, the loss was recognized at the moment of estimation. The moment the company looked at its sales and said, we need to plan for the fact that some of this won't come in. And that's a powerful shift in thinking for anyone going into business. It's the difference between reacting to problems and having the foresight to plan for them. And that foresight makes all the difference.